We uncover the real story behind American private consumption and its potential impact on the U.S. economy and how it could affect economic growth in the near future. The United States gross domestic product (GDP) measures the total production of goods and services in the country. Private consumption is the most important component of GDP, representing approximately 68% of it. American private consumption has been strong in recent years, as consumers have enjoyed a period of high savings that they have used for consumption. The economy has grown strongly after the COVID reopening, and the checks delivered by the U.S. government have helped boost consumption. Even that, savings are fading, and credit card balances are increasing, which reveals that Americans are financing consumption with credit cards and not using them for luxuries or vacations. What do you think about the current situation of private consumption in the United States and its potential impact on economic growth?
Hey, make sure to hit that subscribe button and like this video if you found it helpful, and stay tuned for more.
According to the latest household survey, 40% of American households are having trouble paying their bills, and 50 to 57% acknowledge that they couldn't handle an unexpected expense of more than $1,000. Additionally, 68% say they couldn't subsist for a month if they lost their main source of income, their job. These findings reveal the intrinsic weakness of American private consumption. Furthermore, credit card balances have increased significantly, leading the Fed to raise interest rates to curb consumption, which will have a negative impact on GDP growth. The increase in credit card balances and the difficulty many households face in handling unforeseen expenses could negatively affect economic growth in the near future. Despite optimistic reports from analysts about the possibility of avoiding a recession in the United States in 2023, it is essential to consider the weakness of American private consumption and its potential impact on economic growth. If households do not have the ability to pay their bills or face unexpected expenses, this could have a domino effect on the economy and ultimately affect economic growth. Moreover, uncertainty in the labor market is also affecting consumers' spending decisions. Many Americans are choosing to save more and spend less amid economic uncertainty. This shift in consumer mentality is also contributing to the weakness of private consumption. So, what does all this mean for the future of the U.S. economy? Well, despite some analysts' optimism about avoiding a recession in 2023, it is essential to consider the weakness of private consumption and its potential impact on economic growth. If private consumption continues to be weak, it is possible that the U.S. economy will slow down in the near future. Additionally, other factors could affect the U.S. economy in the coming years, such as inflation, interest rates, and the government's fiscal policy. If inflation continues to rise, the government may be forced to increase interest rates to keep it under control. Even that, this could have a negative effect on private consumption and economic growth. What do you believe should be done to address the weakness of private consumption and ensure sustainable economic growth in the long run? Regarding the government's fiscal policy, increasing public spending and reducing taxes may stimulate economic growth in the short term. However, if these fiscal changes are not sustainable, they may have a negative impact on the economy in the long run. In conclusion, while some analysts may be optimistic about the U.S. economy in the coming years, it is important to consider the current challenges of private consumption and its potential impact on economic growth.